When you turn a rental into a primary, you're going to want to live in it for at least 2 years to get some sort of exclusion. However, the 2 out of the 5-year rule mostly only works if the first 2 years lived in it as a primary. When you have it as a rental and then you move into it, you have what's called non-qualified use. You have to prorate some of the gain based on when you were living in it and versus when you were not living in it. And I know it sounds really weird, but that is a powerful strategy, is to move into a property that's heavily appreciated that was a rental, help you reduce your tax bill. What's going on, everyone, and welcome back to the podcast. In today's episode, we're going to talk about a very commonly asked request. We're going to talk about when you rent out your primary residence or a property that was once your primary residence, let's say. So we get this question asked all the time from clients, and there's a lot of things that you want to think about when you're going to go and rent out a property that was once your primary residence. The very first thing you're going to want to think about is the capital gain exclusion. So, a lot of people don't know this, but if you live in a property for at least 2 years, you can exclude up to $250,000 of the gain if you're single, and up to $500,000 if you're married filing jointly, assuming that you lived in the property and owned it as your primary residence for at least 2 years. Okay. So, the majority of people, when they go to sell their primary home, they don't pay any taxes on it because of this rule, and it's just the government incentivizing homesteading and settling down and etc. So the rule on this is 2 out of the last 5 years. So I could live in the property for 20, 25, 30 years. It's just 2 out of the last 5 years have to be used as my primary home, owned and occupied as my primary home, in order to qualify for this. So what do we see normally happen? Well, you're gonna live in your home for at least 2 years, and then this question always comes up of, should I rent it out, right? And why? Well, let's say you bought a bigger house, but this old property has a super low interest rate. You became an accidental landlord. You want to rent it out. There's some other things you got to think about before you go ahead and start renting it out. The biggest thing that comes to my mind is you can rent out the property, but just keep in mind that 2 out of the last 5-year rule. Basically, if you once you move out of the property, that starts your 3-year clock to where you have to sell that property before the 3 years is up, unless you wanna pay capital gains tax on the gain. And so sometimes it's better to just sell the property and lock in the tax-free cash than it is to make it a rental, okay? Because here's the thing is, if you hold on to that for at least 3 years and you don't get rid of it, the only way you can get out of having to pay the tax bill is to do a 1031 exchange. And anytime you can sell a property tax free, I would 100% every single day of the week take tax free over tax deferred, because a 1031 is just deferring the tax bill. It's not eliminating it, right? It's just kicking the can down the road. So think about that before you go to make your primary home into a rental property. The other thing that kind of comes up with this is, make sure to adjust your insurance, like your homeowner's insurance, because a lot of times people have a regular homeowner's insurance policy and it's not covering dwelling use of other people. It's not covering rental use, commercial use, whatever. So make sure if you are going to rent out your primary home, that you switch over your insurance before you start renting it out. Also, financing. Going to be way easier to refi or pull money or pull equity out of a property if it's your primary residence, when it's your primary residence, than if you convert it into a rental, because now you're going to need P&Ls, you're going to need tax returns showing it as a rental property instead of your primary residence. So make sure that you get all that squared away before you turn it into a rental, and just so it doesn't come back to bite you. I guess I'll throw another thing in the ring. I don't have it in my notes here, but I'll throw another point out there is, also be very careful if you're going to go and transfer it from your personal name to an LLC, because that could trigger transfer taxes with your local your municipality, right? Your local county might have transfer taxes. The other big thing to think about is it even worth holding it as a rental? Because if you're sitting there and it's like, okay, I got $300,000-$400,000 of equity in this property, which again, I can most likely take tax free. Well, I need to compare the equity that I have in the property compared to what the property's going to earn me potentially as an investment. Like, let's say I only have I'm only going to make $8,000 a year in cash flow, but I have 400,000 of equity tied up into it. I would have to rent the property out for 50 years just to break even on what I could walk away with. That's a 2% return on my equity. I would much rather you sell that property and move on to something else than hold on to it and only earn a 2%. Especially remember too, especially because your 5-year clock, 2 out of the last 5 years, right? So when you leave the property, you have 3 years before you have to sell it to harvest those gains tax free. So you want to do this sort of cash on equity analysis to say, well, hey, is it even worth renting it out? Depreciation recapture, keep that in mind when you depreciate the property. So let's say I do the 2 out of the last 5 years. So I live in it for 2 years. I rent it out for 3 years, and then I sell it before the 5 years is up. You still are going to recapture any sort of depreciation that you took. Okay, so just keep that in mind that the 500K exclusion doesn't qualify. Depreciation recapture isn't excluded under the 500K gain. The other thing that's important to note is, and a lot of people get confused by this, is when you convert your primary into a rental, the fair market value of that which you get tax benefits on is based on your original cost basis, not what the fair market value is of the property. Okay. So that could catch some people by surprise where it's like, let's say they bought a property for 300K, now it's worth 600K. They think if they turn it into a rental that they can depreciate off 600,000, but it's actually the original cost basis plus any sort of improvements. Okay. So keep that in mind. And that's why it may be better to sell it and buy something else and use that as a rental as opposed to renting out your old primary residence. It's just something you kind of got to see. The other thing I've been getting asked a lot of questions about is like turning a rental into a primary. What are the things around there? So, very similar rules to that. When you turn a rental into a primary, you're going to want to live in it for at least 2 years to get some sort of exclusion. However, the 2 out of the 5-year rule mostly only works if the first 2 years are lived in as a primary. When you have it as a rental and then you move into it, you have what's called non-qualified use. So you have to prorate some of the gain based on when you were living in it and versus when you were not living in it. And I know it sounds really weird, but make sure you work with an accountant or a tax advisor on that. But that is a powerful strategy is to move into a property that's heavily appreciated that was a rental, help you reduce your tax bill a little bit. But and then also think about too, if you depreciated a property or did cost segregation on a property that was a rental, and then you move into it, when you go to sell it, remember the depreciation you can't the there's no exclusion on the gain when it comes to depreciation recapture. So you're going to have to pay that depreciation recapture regardless. So those are just some things to keep in mind. Like I said, the first thing I would always start with is figuring out, do I qualify for the 2 out of 5-year rule? If I do, well, that means that I can sell that property completely tax free up to 500K if I'm married, 250K if I'm single. And that's just a great, wealth building tool that way. And that's where I really want to do the cash on equity analysis to determine if it's even worth holding it as a rental for those 3 years or not. Because ideally, from a tax perspective, you're going to want to get rid of that property before the 5-year mark is up anyway. So that way you can take advantage of your tax free $500,000 gain. Because remember, always rather take tax free than tax deferred. So keep an eye on the capital gain exclusion. Keep an eye on that cash on equity. Remember to update your insurance and take a look at your financing or your equity in the property before you make it a rental. Because, like I said, that stuff just gets more expensive once the property becomes a rental than before. And then lastly, just remember about depreciation recapture, as well as your cost basis when you go to rent out the property is what you originally paid for the property plus any improvements. It's not the new appraised value or the fair market value of the property. So those are some things to think about when you're looking to convert a primary residence into a rental. Truth be told, I think a lot of our clients end up keeping it as a rental for at least those 3 years. I would love to see people most likely would be better off by selling their property and taking the money and putting it into something else. But I think a lot of people are also like sentimentally attached to the properties that they used to live in as a primary, and they don't really see it from just a pure investment perspective, which is totally understandable. So those are some things to think about. I will see you guys in the next episode. If you enjoyed the show, make sure you share with a friend. That's the only way that this thing grows. I don't have sponsors or I don't have ads. Nobody pays me to control what I can say. So if you get a really good value out of this, make sure you share with somebody else because it truthfully can help somebody else. So thanks again for tuning in. We'll see you guys in the next episode.